Most people think a mortgage rate is a fixed number set in stone by the mortgage company or bank or credit union. It's actually not. It's a moving target influenced by your credit, your down payment, and even the time of day you lock it in. But more importantly, the market. Today, we're pulling back the curtain to show you exactly how the mortgage price actually works. Hi, my name is Erica Slayton, and I'm a 30-year mortgage veteran. Thanks for following me here at Let's Talk Mortgage Pro. Please be sure to send this to any one of your friends or family or someone that you might know that's looking to purchase a home or refinance. Here is a secret. The rate itself doesn't actually change like you think. What changes is the cost to get the rate. Think of it like a gallon of gas or a dozen eggs. A gallon of gas is always a gallon of gas, but what changes? The price. Unfortunately, lately, too much. 5% is always an available interest rate, but at what cost? Because mortgage rates are tied to the bond market, specifically the mortgage backed securities bond market. And those prices fluctuate every single day, Monday through Friday. It's actually the yield that changes. When the market is volatile, lenders might even issue a midday price change. This means your quote at 9 a.m. could be completely different than by 2 p.m. And when we talk about interest rates, we are really talking about the market price of the mortgage money at that exact moment. This is why it's so incredibly important for you to be working with a lender that knows how to watch the market, what impacts it, and what to watch for you. You also have more control over your interest rate than you might think. With a rate buy down, you can actually pay more money in closing costs to buy down the interest rate lower for the life of the loan. This lowers your monthly payment, but raises your cash to close at closing. Whereas with a lender credit, you could take a slightly higher interest rate. In exchange, we could actually pay some or all of your closing costs. Of course, this is a great strategy to keep more cash in your pocket, but realize this does come at a cost, which means a higher monthly mortgage payment. There's also something called a temporary buy down, and not all programs offer it, however, most do. But this is where your interest rate is temporarily lowered for the first 1, 2, or 3 years of your mortgage payment. It's kind of like a stair step, baby step to the higher payment as time goes on. It's a great introduction to homeownership, especially when the seller's paying for it, because it's expensive. Now, why does your specific profile change the rate? The government and investors have what are called price adjusters. Price adjusters are things like, for example, for your credit score. The higher score generally means lower cost for lower interest rates. And occupancy. Is this your primary house or an investment property? Investments in second homes, for example, offer higher risk for banks, so the rate cost is going to be higher for you. And down payment. Your skin in the game totally matters. The more you put down, the better that your rate and your pricing looks. And don't forget, when you're using some sort of down payment assistance program, well, those programs generally set the interest rate, not your lender. Now on to the Federal Reserve, because I get asked this almost every day. Did the Fed raise my mortgage rate? The short answer is no. The Federal Reserve sets the federal funds rate, which is the short-term bank lending rate. While mortgage rates usually follow the same trend, they actually track the 10-year Treasury yield more closely. If the Federal Reserve raises rates and the bond market has already priced it in, expecting it to happen, then mortgage rates might not move at all, or they could even go down. Mortgages are complex financial instruments, but they don't have to be confusing. My job is to help you find the right balance of rate and cost for your specific goals. If you're ready to see what your personalized numbers look like, let's talk. And don't forget to like and subscribe for more transparency in mortgages. I'm Erica, and I'll see you around.